We are on a mission to help 1 lakh investors reach a 1 crore portfolio. You can start from wherever you are, even with a small amount. All we ask is that you think big and stay committed. If you're someone who wants to build wealth the right way, backed by research, discipline, and the right support system, we would love to work with you. Or if you know someone who needs this, share this with them. Let's start the conversation. Fill out the form in the description below, and our team will get in touch with you.
So first of all, thank you for everybody who's here today. I hope you can see my screen. Uh, Today's webinar was about having smarter sources of income in retirement. The basic goal behind setting up this as a webinar topic is because we've been interacting with a lot of clients who are close to retirement or younger clients who are dealing with their parents' retirement coffers. And one thing that kind of stood out is that a majority of people are still choosing to have traditional sources of income, either through their owning bonds or through owning fixed deposits. Now, the migration from fixed deposits to bonds has actually been a little riskier for the client, and they've not really understood that what comes in that package, right? It's not just about the fixed return, which is higher. It's also about the risks that you're taking when you're switching between products. So we were thinking about, what is a smart way to manage risk effectively and also to be able to generate that steady income through retirement without losing much. So today's topic is going to be all about systematic withdrawal plans. And we're going to show you the power of using a mutual fund retirement portfolio over the traditional options of either fixed deposits or even bonds, because today the idea is that a bond can give you a higher interest rate than the fixed deposit. So let's get in. A quick look at today's agenda. We're going to look at the traditional versus modern approaches of creating retirement income. We're going to look at how SWPs versus interest income, how does that work? And then we're going to cover some myths and misconceptions, as well as how we can get started with a systematic withdrawal plan or an SWP. So first, let's look at the traditional approach, which is interest income. So either you're going to own a fixed deposit, which is your FD, which is typically offered by banks and NBFCs. And the idea here is that you get a fixed interest rate for a fixed tenure. Then we move on to bonds, where these are either issued by corporates or the government. And then you also get a periodic interest, which is known as a coupon. Now, with bonds, there are 2 or 3 other things that we should know. Firstly, in terms of who is the issuer, so who is the person who's lending, borrowing this money, there is a system of credit ratings. So your government is obviously going to be the safest issuer, and then you have public sector companies, or you have banks, which are considered to be very stable borrowers. And then you have corporates, which will have a higher rating in terms of AAA. And then you go all the way down the yield curve, the credit curve, where you might have somebody who's even an unrated issuer. So AAA is the best rating beyond sovereign, which then you have AA, and then you have A, and then you have BBB, and so on until you get to D. So D essentially means that you're at default. C would indicate that you're very close to default. And of course, with bonds, they're not all the same. In bonds, covenants matter a lot. And this is something that we've covered in previous webinars as well. So more than just looking at the interest rate in a bond, you also want to see who is borrowing that money. How long are you lending it for? Are there any clauses that protect you as an investor? Are there any clauses that are more favorable to the issuer? So when you understand these things, you will also be able to relate as to why the return from a bond is significantly higher than the return from an FD. So in the traditional approach, we're going to look at the pros and cons of this process. So if we look at the pros, of course, there is a sense that when you're doing a bank FD, there is capital protection. And there's also an insurance limit of 5 lakhs. Now, over and above this, I think historically, you've never seen a bank default on a fixed deposit. You have seen instances where in cooperative banks, that the money takes time to come back, but I don't think there's ever been a situation where investors haven't got their FD money back. The big advantage, of course, is that returns are very predictable, meaning you know from day one exactly how much you're earning, and that never really changes. So if I log into a 5-year FD, then I know that for the next 5 years, this is the return that I'm going to get. I also have the option of making sure that that income comes to me directly, or it's allowed to stay in the FD and compound over that period of time. Now, the risk perception in this is that it's very low, in the sense your capital is completely protected, your returns are fixed, right? There is no variation in these two parameters, which a lot of investors seek comfort from. And there's, of course, no market risk, meaning what happens in the outside world, whether interest rates change, don't change, none of that really affects your fixed deposit investment. When we look at the cons, I think most investors can agree today that FD returns are low and they're only going to get lower from where we stand today. So for somebody who is retired, who wants to beat inflation, or somebody who's younger and wants to create wealth, this is really not helping in that sense. The the return expectation needs to move up in order to achieve these other goals. The next problem that you have is reinvestment risk. So imagine an investor today goes and locks into a 5-year FD. In the next 5 years, it's very likely that interest rates will move up. And at that point, they will be stuck with a lower yield investment. So the idea of where are you going to be able to invest, or at what return you're going to be able to invest, is obviously fixed based on where you are in the interest rate cycle as well. This may not be evident in the sense, unlike a mutual fund where you can see mark-to-market movement and you can see a loss in the portfolio, in the fixed deposit route, you're not really going to see that loss. You're just going to lose out on it, which essentially means that this is an opportunity cost, right? It's not something that you directly pay, but it's something that you pay without your knowledge. The third point, of course, is that it's not as tax efficient. Now, when you're a fixed deposit investor, regardless of whether you're taking that interest income out every year or if you're allowing it to compound within the fixed deposit, you are liable to pay tax on that interest income, whether it's notional or realized. Now, this being said, for an investor who's in the highest slab, you're going to pay this year on year. Whereas if you are an SWP investor, what would tend to happen is that you only pay tax on the capital gains. So based on what you withdraw and how much you withdraw, it doesn't matter whether the whole profit is, I mean, it only matters if you take out your entire fund. It doesn't matter if you're withdrawing month on month, because each set of units will have the capital gains prorated into it. So your tax liability, even though the rate of tax is going to be the same in your FD as well as your mutual fund, the rate of tax is a little bit more efficient in the mutual fund option. Liquidity, of course, is poor. So every fixed deposit investor knows that the day that you decide to break your FD prematurely, you end up paying some kind of penalty in terms of interest. So while you do have access to that money, you actually lose out more on returns when you make this decision. We have spoken about inflation risk when I talked about low returns. And the most important thing here is that your capital doesn't really grow. It is protected, but it doesn't really grow. So if I do a 10 lakh FD today for 5 years, at the end of 5 years, I would have earned some interest income on my fixed deposit, but my original capital remains intact. So it hasn't grown over a period of time. So now let's talk about what systematic withdrawal plans are. And SWP essentially allows investors to withdraw a fixed amount every month, or you can change that period as well and say that you want it once a quarter or once a week. Whatever your comfort is, an SWP can be structured to give you income on a regular basis. Now, what comes out to you obviously does not grow, but what remains in the mutual fund continues to grow. This is an important distinction that all of us need to keep in mind. So the way that we can think about an SWP is that it's kind of the opposite of an SIP. So instead of putting money in, you're actually taking it out from your mutual fund. So I'm just going to forecast a very simple scenario for all of us to understand how this works. Let's say I put 12 lakhs in a debt mutual fund and my return is around 7% per year and I'm withdrawing 10,000 rupees every month. So the amount that I've withdrawn by the end of the year is basically 1.2 lakhs, right? And the interest earned on the average balance, that is obviously on month zero, my balance is 12 lakhs. On month two, my average is 11.9, and so on and so forth. By the end of the year, I am probably at 10.8 lakhs. So then the interest that I've earned for the year is about 80,000 rupees. So my portfolio actually only reduces by 40,000 rupees and it's not by the entire 1.2 lakhs. So what you can see is that while you're taking down from your capital, you're also earning something on the remaining capital. Now, this is where a lot of investors feel that SWPs just don't suit them because at the end of 1 year in the FD, you still have your 12 lakhs intact. So now let's talk about interest income versus SWP. So from a liquidity perspective, your interest income from FDs are low and bonds, it's even lower, right? Because bonds themselves are illiquid. If you break an FD, you have to pay a penalty. You might lose some of the interest that you earned on it. When we're looking at an SWP, you have much higher liquidity. In today's environment, most debt mutual funds come without a lock-in period, so there is no exit load or penalty that you have to pay when you take your money out. Now, your SWP, of course, is a fixed amount. So let's say 1 month you have a higher expense, you can still initiate a redemption request and have that income. So it gives you a lot more flexibility also in terms of how much you're taking out. When we think about returns, your returns are fixed within FD or a bond. You know at the time of investment what your projected return is going to be, and that's all that you're likely to earn. Within mutual funds, your returns are market linked, and you can potentially earn higher returns up to 1%. So, depending on where you are in the market cycle, where yields are, and how spreads are situated, the maximum kind of excess return you can earn over a fixed deposit would be about 1%. Now, we discussed tax efficiency and treatment before, but I'll just reiterate it for everyone who's come in a little bit later. With a fixed deposit, any interest that you earn, whether it's notional or realized, is taxed at your slab rate. With the SWP, what happens is you are only taxed on the gains that you realize. So, for example, in that investment where we saw that the 12 lakh corpus grows by 80,000 rupees and you're withdrawing 1 lakh 20,000. When you're taking out that 1 lakh 20,000, only a part of that 1 lakh 20,000 has gains in it. It's not the full amount that will get taxed. Whereas if that 1 lakh 20,000 came from an FD, that would be entirely taxable as interest income. So with respect to flexibility, your FDs are rigid, meaning you decide on day one how long you're going to invest and what the interest payout is going to be. And there is a fixed frequency in which you're going to get your interest as well. All of this is predetermined on day one. And depending on the frequency of your payout, your interest could, your returns could also change, right? Whereas in a mutual fund, if you're doing a particular investment in a particular fund, then all investors earn the same kind of return. So the goal here being that if you choose a monthly withdrawal, you're not actually going to earn a less return than somebody who chooses a quarterly withdrawal. So this is an important feature when we're considering how we want to structure our retirement income and how we want to make sure that we have the right amount of growth that's there in the portfolio. So the next big concern for most retirees is in terms of inflation. So typically your FDs offer a negative real return situation, which would mean that your returns are less than your inflation rate. More importantly, I think FDs don't really adjust with the interest rate cycle, meaning when you're in a phase of low inflation, your interest rates would trend down, but somebody who's already invested is likely to have a higher return. But when your inflation starts picking up, you're still stuck with a low return FD. And unless you are in the shorter end of the curve, that is, if you're doing 1 year deposits, you're not going to be able to adjust to the cycle. But when you're doing shorter deposits, you actually don't get the best returns either. So it's important for an FD investor to also be aware of where inflation and interest rates are heading so that they can make smarter choices with this instrument. When we're looking at SWPs, because this is market linked, right? Your yields are to inflation data, and you do see movement according to where the macros are pushing you. This is why there is a potential to earn more in a mutual fund versus what you're getting in a fixed deposit. So market linked returns work both ways in the sense that, yes, you could also see losses in a market linked portfolio. You could also see variation in return rather than a fixed return. But this could be both a positive and a negative depending on how you are focusing and structuring your debt mutual fund portfolio. So when you talk about reinvestment risk, it's much higher in an FD where you have to reinvest as your FD is mature, and you will have to decide the tenure of your FD based on where we are in the interest rate cycle. When it comes to mutual funds, reinvestment risk is low. Also, this is a decision that the fund manager automatically assumes. So portfolios do adjust to new macroeconomic situations without you actually having to pull it out any money. So this is a great way to stay invested for the long run, and this allows your investments to compound for a longer period of time. So when it comes to ease of planning, I think FDs rank really high because they're predictable and you have a limited cash flow, but a known cash flow. There is no variation. So with a SWP, I think you can plan, but this requires a lot more planning than an FD because in an FD, your capital is always protected. You're not eroding. You don't have to think about what is a sustainable amount of spending. Whereas with the SWP, you do have to calculate, you do have to plan your retirement contracts, and you need to understand what actually works in this context and how much you can afford to take out. And like while you can structure regular income at a frequency of your choice, and there is capital appreciation in this, I do think that planning is much easier when it comes to a fixed deposit. And this is also one of the reasons why many investors choose the FD over the SWP method, because it gives them the comfort that the capital is always safe. They don't have to worry about whether they're spending too much. And there is a comfort in knowing that on a particular month you will have this income in hand for you to spend. So now we get to our case study where we're actually going to study how the SWP strategy works. Now, let's say we start with a corpus of 50 lakhs and we put 12 lakhs and we want to take out about 25,000 every month. That's the income that we're targeting. So that would mean roughly 3 lakhs a year that's going to be spent. So let's put 4 years worth of FD money, 4 years worth of expenses into a debt mutual, right? And let's assume that the return on this is about 6%, and the remaining 38 lakhs we're able to put into equity or any mutual fund that we're looking at with a 10% return. So the reason there is equity, of course, on this board, but if we look at, say, even a multi-asset kind of mutual fund portfolio or a balanced kind of strategy, then I think 10% is a reasonable return expectation to have for that kind of portfolio, right? It doesn't have to be a pure equity. So this is the first step that we're going to conduct. Then the next step is, of course, to start your SWP. So let's assume for the first 4 years, we take out 25,000 every month from the debt fund of 12 lakhs. Now, what gets spent at the end of 4 years is obviously 25,000 into 3 into 4 years, which is 12 lakhs. But interestingly, assuming the return is 6% throughout this time, the corpus that you have left in the debt fund is close to 1.6 to 1.7 lakhs, right? Then your equity corpus or your multi-asset corpus, whatever you want to look at, 38 lakhs grows at 10% compounded. So the value after 4 years is roughly 55 to 56 lakhs. So you've made a lot of money on this. You've actually made more money than 12 lakhs, which allows you to replenish your debt corpus again. So, and you also have a little bit left over from your debt corpus. So what happens now is that you move about 10 lakhs from equity to debt again, and you repeat this 4-year SWP, and the equity corpus continues to compound. So you keep doing this for a block of 4 years, and at the end of 20 years, what you would have withdrawn totally is basically 60 lakhs, because 3 lakhs a year into 20 years. And what's left in your portfolio is about 1.4 crores. So this essentially tells you that there is a way for you to spend and grow your capital, as opposed to an FD strategy where you're spending, but you're not really growing your capital. Now, we also ran another simulation where we said that, okay, what is not fair is that we're saying that a mutual fund or an SWP strategy can help you beat inflation. So we ran another simulation where we said that let's assume that we're adjusting for inflation and we're also we're increasing our spending every 4 years. Right. So let's say in the first block of 4 years, I'm spending 12 lakhs. In the next block of 4 years, I'm spending 15 lakhs and so on. So when we do that, your total spending actually comes close to 1 crore, right? And let's say we start with that initial investment of 50 lakhs in all 3 cases. Where are we left at the end of 20 years? So at the end of 20 years, you end up with almost 1.4 crores if you just withdraw the same 12 lakhs every 4 years. You're left with 60 lakhs if you adjust for inflation. So even for somebody who wants to sustain or maintain their lifestyle through their retirement years, the SWP strategy allows you to do that and actually leave more on the table. So there is a lot for investors to think about in terms of what SWPs can do for them. Right? While having a mutual fund portfolio can complement any other sources of income that you have. And even if we compare this with, say, another option where you have rental income, I think there are some practical elements that are involved that a person needs to think about. When you retire at, say, 60, it's a different situation than when you're 70 years old. Right? At 60, you may still have the energy to run around, manage tenants, take care of certain things, operate on repairs, and do all of these things when you're managing property. Rental income can also fluctuate because if you lose a tenant, there will be a gap between the time that you get your next tenant. So there might be months in between where your income is not stable. With either an FD or an SWP, the stability of income is always guaranteed. So it's important for every investor to think beyond, the basic logic and think beyond a period of 1 year. Because if we're able to extend our timeline and if we're able to extend these calculations for a period of at least 5 years, we're able to create some level of wealth and financial security. So now we'll come into the myths and the misconceptions. So a normal person would obviously look at how the capital is depleting over this 4 years. While you don't go to zero on the debt funds, you definitely come down a significant amount. So if you've invested 12 lakhs, at the end of 4 years, if you see only 1.5 lakhs in that account, that does create some cause for concern. So here, the thing is that you worry that your capital will run out quickly. But if you have planned withdrawals, and I said that this is where I think FD planning is much easier than SWP planning. If you really understand what is a sustainable rate to take out, right, in your case, based on all of your assets, if you do these planned withdrawals and you limit how much you're taking out, you can actually grow your capital as well as take out some income. Are SWPs actually risky? You can choose debt funds that are not so risky. You can choose arbitrage funds that have actually zero market exposure. I mean, net zero, there is no equity exposure. So it doesn't matter what's happening in terms of the direction of the market, right? Your arbitrage funds can deliver returns even when the market is moving down. You also can look at income plus arbitrage, which is a new category that the industry has launched, with the basic goal being that you extend your timeline to 2 years instead of 1 year to get that tax benefit. It's more tax efficient than a pure debt fund. But I think just debt or arbitrage in itself would do the job for an investor, because most people are either looking at tax efficiency, which means the earlier it is for you, the better it is, or they're looking at stability in terms of returns, where I think a debt fund works out well. Now, FDs are safer in the sense that it depends on what your definition of safety is. If your definition of safety is that your capital will never erode, that there is a lot of credit quality in terms of you keeping it with a highly recognized bank, then yes, FDs give you that stability. But when we start thinking about safety in terms of being able to maintain your lifestyle or having flexibility in terms of deciding how much you want, because your expenses can vary month on month, then I think that's not really as true as you would think. It's safer from one perspective, but it doesn't give you very important things that a retired person actually needs. So your next thing is that returns from mutual funds aren't guaranteed. Now, this is absolutely true. Of course, you cannot guarantee any returns, and even investors who look at metrics like yield to maturity should be aware that this is not guaranteed, right? If you have a YTM, that's just an indicative return at a point in time. It doesn't mean that that is going to be the return for the investor at all, right? But what we have noticed is that long-term returns in high-quality funds tend to be more reliable. Like you can set a return expectation, and you can have a very reasonable return expectation of 10% compounded if you're looking at a asset allocated portfolio, or at least 9 to 10% in that case, and maybe a slightly higher return if you're looking at an equity oriented portfolio of 10 to 12%. Now, what if the market crashes? Okay, so over 10 to 20 years, markets are going to recover. I don't think we need to worry about the blips in between. At the same time, when you're structuring your retirement corpus, it's important not to put all of your eggs in one basket. It's important to choose funds that work with the current market cycle. It's important to be disciplined in doing that rebalancing as and when you're booking profits from your equity portfolio. It's also important to select the right products. So this is where working with a distributor or a professional can actually help you make sure that you're managing those risks effectively. And if we look at downturns, the fact that you have asset allocation itself within the mutual fund universe, meaning you can very easily have precious metals, fixed income, equities, global equities within your mutual fund portfolio. It's not that you need to only own domestic stocks or indices who are affected by market movements. So the last thing that we're going to cover is whether SWPs are only for retirement people. And I think here we need to acknowledge that this is a tool, right? And SWP is a tool, which means that anybody who needs a regular source of income can actually start using an SWP. So what do I mean? If you're an entrepreneur or if you're an artist, you may not have a monthly salary that's coming in. So you can actually put your savings into an SWP, and the income that you receive can actually go into your portfolio growth. So you can flip this so that you get that sense of financial security. At the same time, you don't miss out on investing opportunities. So how can you get started with an SWP? I think you need to choose the right fund. You need to look at low volatility funds, and you need to also preferably look at debt or arbitrage to make sure your income needs are met. You also need to plan your withdrawals, which means that you need to decide how much and how frequently you want to do your withdrawal. And you need to consult a professional, because I think this shift to move from fixed deposits to mutual funds is actually a fairly big shift. It's not something that you should navigate on your own. There can be a lot of surprises that you're not expecting in this journey. So having somebody who can explain all of this and be able to understand your overall financial situation, as well as, to be able to structure your goals and everything else that comes in that retirement package will be very helpful. So quick takeaways. I think the SWP offers flexibility, tax efficiency, and allows you to benefit from inflation adjusted income. It also helps you generate a regular cash flow without affecting your investments, right? And it also allows you to grow your wealth, because any investor who is concerned about wealth preservation can also benefit from the SWP. You just need to give it time, and you need to see a full cycle before you see the benefits of this. And we do think it's a better and superior alternative to traditional interest income in many cases. So there is a lot of merit in looking at this. And this can be something that you do for yourself. You can do it for your retired parents. You can actually spread the word about how you can create wealth through mutual funds. So if you're ready to start your SWP journey, then we are here to help you. So what is it that we do for retirees? We're able to help you plan your expenses. We're able to help you map out your post-retirement goals. We're able to help you with your asset mapping and allocation, which means we can kind of see what your asset allocation looks like today, whether it's appropriate for your risk profile, your income needs, and so on. And then we can give you a target asset allocation to work towards, and then we can help you get there as well. And most importantly, we can help you with your mutual fund investing, which essentially means that this decision of where to invest, how to structure the SWP so that you're able to create as well as enjoy your wealth can be handled by our team. So a little bit about milestones to wealth and finesse. So we essentially handhold, guide, teach, and coach investors in this process. The goal is to help every investor think big, take you from where you are to your first crore in savings. And beyond that, we're also able to get you to higher milestones. Now, the outcome of the program is that you will get a sense of financial discipline. Your mindset will be more growth oriented. We're able to also build investment conviction as you travel with us through the cycle. You can see how lump sum calls work, how working with the market, understanding what you need to do at a given point in time actually gives you more confidence to do more. And then, of course, like I mentioned, for retired people, we do have a wealth map where we're able to tell you what your post-retirement goals are, what your asset allocation should look like, how we should provide for certain things at the time of retirement. And of course, we also have scalability, which means that we're able to create wealth and also bring out the best for you. So our motto is to go from where you are to 1 crore and beyond. For finesse, we basically run a lot of monthly outlooks on the fixed income side. We do monthly webinars like this one. We also help investors with product selection and in terms of investment reviews, like we would study, let's say, for a retired investor who comes into milestones to wealth, then we are able to study their portfolio and then tell them on a regular basis how they need to rebalance it so that they're able to sustain their purchasing power and create wealth. We do help with portfolio construction as well, which is that if a retired person comes in with, say, their PF money or their gratuity money, and we need to build a retirement corpus for them, we are able to do that. So with that, let me open up for questions. Anybody who wants to start investing can actually drop us a message at 9677000613. And if you reach out to us on WhatsApp, our team will be able to assist you and help you take the next steps in this. And once again, thank you everyone for your participation and for your time today.